Welcome to everyone for the Alliance of Angels workshop today, together with Traction Advising. Our workshop today is about why SaaS buyers buy and what they pay for. And we are privileged to have Lowell to join us today for our session. Just a few quick logistics. We want to keep this an interactive session. So if you have questions, please do not be shy, right? Just speak up, feel free to interrupt. And if you rather not talk and you would rather use the chat in Zoom, that's also fine. But in any case, we really want to hear your questions so we can all have a great experience together. But that said, if you are not speaking, we do ask that everyone stay on mute. Right, your kids are adorable, your pets are cute, but they don't have to be part of our session today, right? And so we ask that again, if you are not speaking, please put yourself on mute so we can all have a great experience. All right. I'm going to say a few words about Alliance of Angels. This is the organization that I run. It is an angel group here in Seattle. There's 140 angels in the organization. Every year we put about 10 million into 20 companies, give or take. Most companies that are fundraising from us, they're looking for a total of between $500,000 and 1.5. And our typical check size is 250 to 500. So, and we are a sector agnostic investor and also a stage agnostic investor. If anyone's an entrepreneur on the line and you are interested in approaching us for fundraising, feel free to send me a note. And my email address is right here. And also that there's always questions about, given the current public health situation, are we kind of all hiding and not investing? That couldn't be further from the truth. In fact, the last year was pretty much, as far as investment activity is concerned, about the same as prior years. So yes, we are actively investing. And if you are looking for funding, or maybe you are an investor yourself and you're looking to get involved in angel investing, feel free to send me a note. And I'm happy to follow up and have that conversation. All right, so now I'm going to stop talking. Right, and I am going to also stop my screen share, and I'm going to hand it over to our speaker today, Lowell.
Great, thank you, Eugene. Let me, am I sharing? Not yet, there we go.
Now you are.
Yeah, okay.
All right, full screen that, wonderful.
Good, well, thank you everyone on a sunny day in March in Seattle for joining. I'll kick it off a little bit. A picture of myself when I had more hair, and just briefly, I had a sales career, Fortune 500. But I think what's really relevant is when I was a co-founder and a CEO of a startup, and then in my early days as an investor, I had opinions or impressions about buyers or why my company would sell or companies I would invest in, who would buy them that were a little bit naive. And I think a lot of people share that just because you don't have a lot of experience to companies that buy. But over the last 5 years, I opened up an M&A advisory, and I've probably had 5,000 conversations with real buyers. And so I now feel like I really know what people are going to pay for and what they're not going to pay for. And I just think some of the anecdotes, some of the highlights that you'll see on GeekWire or in the Business Journal, they're legit, but they don't represent the majority of the transactions that happen. So I just thought I'd share some insights from the conversations that I have. Some of this may be repeat. I'm gonna peel back a little bit, like what a strategic buyer is and what a financial buyer is, just to help people understand. And then I'll talk about some of the metrics that they look at. A strategic buyer is, I would just call it, it's a real company. It's an operating company. They've got products, and they'll evaluate an acquisition primarily on how it fits with the acquiring company's strategic goals. And I'll talk more about that. And again, I focus on SaaS. Our particular niche, we focus on companies 5 million to 20 million in ARR. So that's the area that we know the best, but I'll talk about people in the whole spectrum. The largest SaaS companies by market cap, you've got Adobe, Salesforce, Shopify, Intuit, Zoom, ironically, thanks to COVID, Square, ServiceNow, Workday, Twilio, and Atlassian. A lot of these are household names, but I will tell you there are hundreds, perhaps thousands of large vertically focused SaaS companies that are anywhere from 50 million in ARR to 300 million. And many, if not most of them, are companies that you've never heard of. I'm amazed how often we continue to uncover massive SaaS companies, and they're all acquisitive. So again, we'll talk more about that. So on the financial side, those are people that are putting money to work. So those are hired guns. They raise money. I'll go into more detail. And their goal is to get a return on their investment. So they're long-term investors interested in the return that they can get by buying a well-managed company. So there's private equity that we hear about, and there's a newer flavor of private equity that's focused on SaaS. That is probably one of the fastest growing categories that I'll talk about. Very different than the traditional, buy a company / costs, to turn things around. There's search funds, their family offices, and their venture capital. So I created a slide to kind of talk through each one of these, and then talk a little bit about private equity, because it's a big deal, and it's involved in more areas than most people think. So brief history lesson: Enron was a company that did some bad things. Sarbanes-Oxley was created. It's a federal law, comprehensive business financial practices that hold the CEO accountable. It's like go to prison things. And it's a good idea. The downside was it adds about $1 million, some say up to 2 million in costs. So small companies, if you're a $20 million company with 2 million in EBITDA, and you tack on 1 million or 2 million in costs, and all of a sudden you're not a profitable company, so you can't go public. So shortly after 2002, private equity really stepped in to fill the gap, to acquire companies that would have gone public. And they did really well, 40% IRR in some of the early days. And just to put that in perspective, in a 10-year fund, they turned 100 million into 1.6 billion. And when they turn around and look, where do we put the 1.6 billion, they plowed it back into more and more companies. So you've seen an absolute explosion in private equity. And some other numbers just to kind of give you a perspective. So if you look at assets under management, you'll see they've got 4.5 trillion, which is a big number. And that's up from 1.5 million just in the last 10 years. So there's 3 trillion more in cash in private equity than there was 10 years ago. Just for perspective, that's larger than the GDP of India. It's only slightly smaller than the GDP of Germany. And their total under management, and this is the 2019 numbers, approaches the GDP of Japan. So only China and the US have a large GDP. It's a huge amount of money. New York Stock Exchange has 22 trillion. So there's a lot of money out there, and a lot of money that's looking for a home. And I'll break it down a little bit further. So many of you may know this. If you deal with private equity, I think sometimes it's interesting to know. If this isn't interesting, you can just do email while I talk through it. But basically, private equity has a 10-year cycle. They've got a sponsor. You'll see on top, Riverside is, I think, one of the better private equity companies that's out there. And they'll create funds. So you'll see they've got a European fund, they've got a micro cap, they've got Australia, capital appreciation, technology. And then in that fund, they'll go raise money from investors. That might be wealthy individuals, but it's often insurance companies, university endowments, and pension funds. So not that exciting, but they'll raise a big fund, and then they'll go out and they'll invest in companies. And private equity is very good at making money. So they'll charge the companies a fee. They'll charge a management fee to the investors. So they make money on both sides, and they earn a percentage of the carry, so of the increased value that they produce. So it's pretty straightforward. They'll usually invest in the first 5 years, and then they might do some additions, and then they'll try to harvest towards the end because the investors want their money back. Here's where it gets
Hey, Rick, I've got a question.
Yes.
So why would the private equity charge the companies they invest in?
I'm not sure I know why. I just know that it's pretty standard. Part of it is it's what pays. They consider it a management fee. They feel that they add value to the company, and so they have people that sit on the board. They'll bring in they'll bring in professional salespeople, professional marketing people, professional operational people, and they're able to charge a fee for that. One of the things that they also do, which can be more significant, is if they raise. So often these are leveraged too. So they'll take the investor's money and they'll put 10 million in. They may raise 10 million in debt from the bank, and then the fees that the company actually pays the interest on the loan. So they're paying down the loan and they're paying the interest on it as well. But good question. But it's just a surprise to people when they see it. So part of the reason I throw it out there is just so when they see that in the transaction that they're aware of it. So here's what gets interesting. A lot of the buyers that I see out there today, so you've got a private equity fund, and they'll create a thesis or a strategy. So you look back here, if they're going to buy 1, 2, 3, 4, 5 companies, they're not just going to be random companies. They're going to have a thesis, and typically they'll go out to their investors with a thesis, and they may say this is actually an actual one where they said COVID is increasing our dependence on e-commerce. Small e-commerce companies are struggling to compete with Amazon. So software that helps these small players compete on logistics optimization, so basically reduce their cost of freight dramatically, is an area that they want to invest in. So that's actually a pretty hot space right now. They'll go out, they'll do an analysis. Guys like myself will bring them opportunities, and they'll look for a platform, and a platform is what they'll build around. Platforms almost universally have a minimum of 10 million in ARR. So if you want to be a platform and have that broad appeal, that's the target to get to. Often they can be 10, 20, 50, 100. Some of these bigger funds now, platforms can be 200-300 million in ARR. But here's where it gets interesting. The area that we play is they'll do add-ons. So they may have a platform, but part of their strategy is they're actively looking to add on 2, 3, 4, 5 companies to fill in gaps in the functionality and to add revenue. So there are a lot of very good companies out there that have, like I've got on here, 3 million, 5 million, 7 million in revenue. They're not quite at the platform phase, so they won't be bought directly by the private equity fund, but they're a great fit for these platforms as add-ons. And I'll talk about it later. So you've now got something where the platform the platform is a real company, right? So it looks like a strategic, but they've got private equity backing that has a big checkbook that's actively looking to add on. So many, if not most of the opportunities out there to exit for companies with, call it 10 million or less in revenue, are in these strategics, because they're active buyers, and you can get the best and sometimes the worst of both, of being bought by a strategic and being bought by private equity. So they call them add-ons, they call them tuck-ins, they call them bolt-ons. Why might they want to do that? So sometimes they're looking for geographic expansion. Sometimes they're looking for a product extension. I would say that that's probably the most common. Sometimes they're looking for additional products to sell into the same client base. So if you've got the same buyer, your existing team can easily sell to that same buyer. And I don't even mean the same company, but often it's the same buying influence within the company. Cross-selling, upselling is a big deal. You've got a client base, they've got a client base. The fact that they can sell the other person's products to each other's base, they'll build out a model for incremental revenue and incremental EBITDA. It might be a competitor, and this is always it's a little bit sensitive, because you're dancing with the devil, right? You're talking to someone that's a hated enemy that might buy you. On the one hand, you're sharing sensitive secrets to someone that you worry might copy them. But it is quite common that a competitor will buy you. So we could spend a lot of time talking about that alone. You may have a desirable customer base. For example, you may have a large government contract, and they may have struggled to get into the government, but they have products that they'd like to sell into the government. You may have Boeing or Microsoft as a customer. And then synergy costs, I think, is probably one of the more obvious. So if you've got redundant managers or salespeople or finance people in the background, those are instant cost savings. So this add-on function, I think, is important for people to know. This just kind of shows the relative.
Hey, Lowell, can I ask a question?
Yes, sir.
So I've heard that the private equity firms, they roll up a lot of small and medium businesses, do they face any regulatory issues, or do they have to actually get approval from authorities for, let's say, if they roll up a bunch of sports teams or something like that? Do they face any such regulatory issues at all?
That's a good question. I have not run into that. That would be more of a legal question that I'm not an expert on. But I can tell you that, I mean, I would imagine if you tried to pull together, I don't know, I'm making this up, Zillow and Redfin, there might be some issues, right? If you've got the majority of the market and it's a pretty significant market, typically when there's smaller players, I don't get the feeling there's as much scrutiny, and I don't know that they can roll together enough to really dominate the industry. But I say that I'm not an expert in that. And the roll up is actually pretty common. Oftentimes, I'll reach out representing a company, and I'll say they're in this space. Are you interested? And the response is, well, we don't have any platforms in that space, but we're reviewing 2 or 3 deals that are for sale that we would roll together, and this would blend in with that. So roll up is a pretty common, particularly industries where initially it's very fragmented. A lot of people are involved. And many of them, maybe 1 or 2 becomes wildly successful. Then you've got 10, 20, 30, 40, 50 companies that are good companies, but they're stuck in a linear growth curve. They don't have that exponential growth curve. Private equity will come in and roll them up oftentimes, and take out costs and then bundle it together. But good question. If anyone else has questions too, feel free to interrupt. I'll stop and breathe once in a while. This slide I've got up just to show. A lot of people talk about, we're going to get big and we're going to get bought by Microsoft, or we're going to go public. If you look on this chart, 2019, 26 companies went public, 34 billion total market cap. Private equity bought 600 companies at 185 billion in market cap. So private equity as a generic group may not sound that exciting, but like I said, there's a lot of money there, and there's a path at a smaller exit before you hit some of those big numbers. Another vehicle that's out there are
just a quick question. Do you mind
Yeah.
going back to that slide?
Yeah.
So for 2020, you're only showing first half year, and it looks like there's a massive decline in PE deals, right? Even if you doubled first half and you made that, 300, seems like there's a large decline in PE to PE deals in the second half of 20. Curious what the first couple of months of 21 looks like, because it seems like the markets, the IPO, the public markets are so rich in valuations and multiples on revenue that PE can't compete with it at the moment.
You'd be surprised. Private equity, the multiples are often lower because you get a discount just because it's private, it's not liquid. But the back half, I can find some of the studies I've seen. The year 2020 actually ended up pretty strong. H1 was skewed because COVID was unfolding. In the first few months, everything went on hold. So I think Q2 in particular, not a lot of deals got done. But there's actually a situation in COVID, so many companies, the deal flow that private equity was seeing, the data I got back informally was that the deal flow fell in half. You got to realize these private equity funds still have money that they have to put to work. And every day, and they're all about IRR. So it's all time-based. So they want to put that money to work sooner than later. And anyone that's out there may see a huge influx of interest from private equity. And it makes entrepreneurs feel good, right? I'm wanted. Well, these guys got aggressive because their deal flow fell down. So it's a little bit like real estate, where there was actually less inventory that drove the prices up. And there was a lot of that with exits last year. Is there were fewer companies that were exiting for multiple reasons. I had 2 last year. One, the buyer was hurt by COVID, and the other, actually their business took off from COVID, so they both delayed it. But I will tell you that the market is still strong. I can find some data to back that up, but I can tell you qualitatively that the year actually ended up pretty strong in 2020. Okay, search funds. You'll see, I'll jump, there are 51 funds that were created. Again, this is 2019 data. Basically, this came out of Stanford. where they take an MBA graduate, some successful business people. Think of it like super angels. So instead of writing $25,000 checks, they're writing $250,000 checks, and they actually buy the company, and then they operate it, and then they'll sell it 5 to 10 years later. These guys have done really, really well. Their median IRR is 32.6%, which is pretty remarkable. And they used to focus on more services business. Now there's a subset of these that I know, and I know the investors behind a lot of these that are actively looking to buy software companies, SaaS companies in particular. They like the recurring revenue model. So this isn't for everyone, but for some companies, this is a great fit. And these are two, General Pacific, Alta Lake Equity Partners. One of the keys, this MBA person is going to be the CEO. So if you want to stay on as a CEO, this is probably not a good fit. Family office. Many of you probably heard about family office, a couple in Seattle, Keeler. I think most people know. I think they're actually, parts of them are involved in AOA. East Seattle Partners, that's Fraser, if you know Ignition, that's their family office. They're typically 100 million or more, and they buy companies. They tend to buy boring things like real estate, things that generate cash flow for the family. But more and more, they're getting involved with a subset of their money with technology companies. Their LPs are the family, which is often kind of nice. So it's like working in the family business. Graham is one of the larger ones. They're on the bottom. So their family office is 3 billion, and they're broken up into 6 different groups. One of them is all software. So family office is another sort of class of capital that can be a good owner and can potentially offer a second bite at the apple as well. So you may sell 60% of it to them, and then you continue to run it, as opposed to the previous slide where I talked about search funds. A family office often wants you to stay on, but they want to buy 60%. They want a controlling interest. They'll inject some capital, and they may sell it in 5 years, 10 years, 15 years, 20 years. It all depends. There's another class that I see proliferating, I call them buy and hold software companies. So Constellation is probably the best, most well-known. They're value buyers. In some ways, they get a bit of a rap because they offer low multiples, but their market cap is 29 billion. They did almost 4 billion in revenue last year. So they've been very successful. There are some spinoffs of Constellation that are doing well. There are more and more, honestly, every month, because the model works, and many of them are willing to pay competitive multiples for better businesses. Strategic buyer, we talked about a little bit. So it's a company. They acquire another company, often the same industry, to capture synergies, leverage sales and marketing, reduce costs, add product functionality. What's interesting about strategic buyer, because they may buy you and you've got 100 customers, they may have 10,000 clients. They're going to roll your product out to their 10,000 clients. Even with a 10% adoption, your company goes from 100 to 1,000. So they don't just pay for what you have. They're often willing to pay more for what your company will be at their value. And much of what we help them do is build a model of sort of what that better together story would look like, both what the incremental revenue could look like, incremental profit, because every CEO, maybe not every, most CEOs are struggling with the same problem. They're struggling with hit their organic growth numbers, and they're struggling to hit their profit growth as well.
Raul?
Yes, sir.
How would you answer my I have a stutter. Would you answer my question in chat, please?
I will. My apologies. I'm not good with chat.
And our buyer is interested in strategic denial.
Oh, okay. I see multiple questions. Slides will be shared, so I'll answer that one. Are buyers generally interested in strategic denial of their competitors' access to emerging tech? Strategic denial. Well, I would say, and think I might say it on the next slide. Let me see if this asks your question. On this slide, if you go down to competitor or market share,
That's fair.
eliminating a competitor does that answer your question?
But it does, yes.
Okay. Yeah. No, that's a great question. And I often find it's interesting. Sometimes people, and I saw this when I was on the buying side, where we looked at a company was for sale, they were a competitor. We were interested. At 40 million, and through competition, it got bid up. And then it was less about our desire to buy them. And then it was about how much would we pay to make sure that our hated competitor didn't end up with them. And it was almost the fear of losing them to the competitor was more powerful. The company ended up selling for 110 million. So they created 70 million incremental value because of the competition. So yeah, often the fear, you say, well, this would be nice, but we don't have to have it. But then you think about waking up tomorrow with that as a part of your competitor, and you say, well, we don't want that to happen. So why do strategic buyers, let me make sure I'm in order here. Why do strategic buyers, what's their motivation, right? What about geographic expansion is one. I worked for a French company, moved to Europe, and they didn't have a strong footprint in the US to be a strong tier 1 player. They needed that. So we went out and we ended up buying 2 companies in the US that worked well. And that happens all the time. We talked to a company earlier this week that's based in the UK, looking at buying a US company to get a US footprint. I see a typo in there. Product extension is super common, right? Especially with technology. It might be missing functionality. It might be to accelerate the roadmap, right? It's on the roadmap, but it's 2 years out, right? And there's never enough capacity to get things done. Or it might be a better solution. We've seen it before where they built the solution, but it's a crappy product, or clients don't like it, or there's just a lot of churn. And someone else really cracked the code, like it's really good, it's really sticky, and then they'll buy it to replace the other one. And then, strategics can also be a little bit. It's just more challenging, right? Because sales and marketing might want your product to roll it out, but the CTO is saying, "Hey, I can build that. We don't need to buy it." So sometimes there are internal competing factions that make strategics certainly can justify paying more. They don't always pay more, but they can also be trickier. Certainty to close can be lower because it's just more complicated, and they have a business to run and things can happen. They're not just in the business of buying companies. So I mentioned, the client base, buyer profile, the company can grow if your client base is the same as their client base, even if it's a different product. Entrepreneurs are often surprised that some of the potential buyers don't even do the same thing, like they were never on the radar, but they've got the same client base. They've got 10,000 or 17,000 clients that your company would buy, even though you're currently not competing at all. And that's the cross-sell, upsell products to either side. Competitor, we kind of started with that. Desirable customer base, I talked about. You might have, you've got you're a vendor with Microsoft, and they want to be a vendor to Microsoft. Synergy costs, it's taken out cost. And I just threw a local example in there. A great example, Smartsheet, great company based in Bellevue. They bought 10,000 feet that had very specific, they'd cracked the code on some very specific resource management that was very difficult, both on the UX side. So they bought that and integrated that. It was a great fit for both sides. Some of the priorities, any questions? I'll actually stop and ask. All right, otherwise we'll come back later. So, corp dev, I tell people often, someone will say, hey, these guys want to buy me. And I'll say, that's great. Who are you talking to? It's like, wow, this guy's, he's their partner sales guy. I was like, okay, that's not usually who can sign the check. Do they have corporate development? Is corp dev involved? Is the CEO involved? Because ultimately, the deal's not going to get done unless it's a really large company. The CEO will get involved and have to represent it to their board. So you want to make sure you've got the right people that are involved. They're going to dig into the financials, particularly if they're publicly traded. all of them will probably do a quality of earnings check, and many of them will want audited financials, or they'll do an audit post-close, and then you'll be held accountable to any discrepancies that they find. Technology, if the tech stacks are completely different, sometimes people say we don't care, they'll run separately, and others it could kill the deal instantly. The CTO just says non-starter, we love the product, but we're not going to take on .NET or whatever it might be. The product, we talked about this a little bit, often a competitor, which makes it delicate, and it can be touchy doing code reviews with a competitor. Even though they're a likely buyer, it can just be very sensitive. But we've found creative ways that work for both sides. Customers, they'll typically go deep on your customers. We've even had a couple recently where the buyer wants to introduce the seller to their clients and do a joint demo under the guise of a partnership, which is a great way to pressure test it and find out both from the buyer and the seller side if this deal has legs, like if it really makes sense. So that, again, that can be a little bit tricky, but I think it's smart. Go-to-market strategy, they're going to want to know: do you do inbound? Do you do outbound? Are you really good product team and you're terrible at sales? That's actually okay, because that can then turn into a positive for them. They want to make it better, right? So if you've got a great product, the company's done well, and you're not great at sales and marketing, and they say, hey, you've done this well with our sales and marketing expertise, you can do really well. Pipeline, at some point they'll dig into the pipeline, they'll look at your forecast just to confirm that the pipeline matches the forecast. So these are things to be aware of before you sell, so you can think these things through. Make sure that the pipeline is clean, there's not just garbage in it. Make sure you've really done some ideally some aggressive marketing before you get into the deal, so you've got a pipeline that does support your actual forecast. And then one of the things, I don't think I talk about it later, one of the things I see that's important is well, I'll talk about it later. We'll dive into the metrics. One of the things, it's growth and retention is what buyers want in SaaS companies. And that's my last slide. If you remember nothing else today, they like growth and they'll pay for it, and they like retention. Customers that stick, and not only they stick with you, but they buy more year after year. A lot of people don't give a lot of thought to what hits the logo churn number. So if everyone that's interested is signed up as a customer, it makes your churn numbers look higher. So people on trials or pilots, there are ways that you can not count them as customers. So if there's high churn on the front end, they don't hit your longer term churn numbers. And the reason I say that is things like that can make the difference between it being a 5 or a 6x or a 7x exit. So literally multiples of your revenue with some kind of simple tips and tricks. So talking about strategics and financials, and the reality is a large portion of the potential buyers for most companies are a bit of both. So this slide just shows if I went to Riverside, searched their portfolio, I could find companies like Arcos. If I looked at your company and did a search for strategic buyers, I would come up with a company, Arcos, and then I'd find out they've got a private equity sponsor in the background. And that's okay. In fact, it's good, because the private equity has a big checkbook and they've got money they need to spend. All right, I'm going to do a time check. All right, I'm going to speed up a little bit so we have time for Q&A. So in SaaS valuation, we try to look at our buyers, and we're pretty direct. Are you EBITDA buyers or are you ARR buyers? So some are focused on the EBITDA, so your ability to generate cash flow, and those are typically going to be lower valuations than from the ARR. That's not always the case, but it is almost always the case. In some reasons behind it, private equity, they're leveraged buyouts. They need to borrow cash. They can't borrow cash against a business that's losing money. Strategics, sometimes the strategic buyer they don't want to pay 10x multiples of revenue because they're being valued on 7x multiples of their EBITDA. So you got to kind of watch for that alignment. ARR buyers usually they've seen the light and they're pretty committed. They love the contractually recurring revenue, not having the uncertainty. So, and more PEs, I think literally every month, are starting to see the value there. So they're migrating away from some of the traditional businesses. And then some of the strategics, critical functionality, or their valued at revenue. So, so that's the first kind of big category. Clearly you want to be valued. So it doesn't mean that EBITDA doesn't matter, but it means that you want to be valued on the revenue. So, all right, so here's kind of the heart of it, right? What drives the valuation? So if you take the exact same profile of churn and growth, if you're at $1 million, there's a very small group of people that will buy the company. That it happens a lot, but it's tough. Once you hit 5 million, it's doable, particularly for smaller SaaS companies. 5 million might be accretive, so it makes a difference immediately to their total revenue, and you've got enough scale that it starts to become interesting. You remember earlier I talked about the platform size. You're not a platform. If you're above 10 million, there's probably an order of magnitude level of interest in buying the company than if you're below 10 million. It may feel artificial, or if there's a path to 10 million, but the multiples are higher. You see like Peakon being bought by Workday. You remember when Qualtrics was bought? Those were 20x multiples. And I see a lot of people say, hey, market's hot, I want the 20x. I'm like, well, you're 6 million in revenue, you're not going to get a 20x multiple. There aren't very many companies north of 100 million in revenue growing 40-50% a year. And if you're in that category, you're going to get extremely high multiples. Over 10 million, the multiples are definitely higher than below 10 million. It's kind of the message there. So, categories of growth, you've got some companies, well, I think I'll talk a little bit about size. So customer concentration. So let me go back to profitability. The company doesn't have to be profitable, but I hear some people that say profitability doesn't matter. It's all about growth. And I say, well, not really. If you're burning the equivalent of 100% of your revenue in a year, even if you're growing 100%, I can tell you a lot of potential buyers are going to be afraid of that, just because you're burning. It requires so much money to keep that engine alive. If you're close to break even, if you're minus 10%, it's probably not that big of a deal. But I'm talking about companies that are like 50, 100% growth. If you're in a more typical 10, 20, 30, 40% growth, it'll be a lot easier to sell if you're at least break even. So break even does matter. So I hear a lot of people that and I used to say that, it doesn't matter, it's all about growth. Not really. Customer concentration can be an issue. There's no hard and fast number, but I can tell you if 70% of your revenue is with a single client, that's a big risk, and that's going to hurt your valuation. Their concern is if that contract doesn't renew, they just bought a company that's a third of the size that they thought they were buying, and they may put contingencies in place to protect themselves. But a broader customer base, anything 50% or more is certainly going to catch your attention. Ideally, no single client more than 10 or 20% is ideal. Logo churn tends to be higher with SMB, less with mid-market, even lower with enterprise. I'm going to talk more about that in a minute. Net revenue retention, I'm going to talk more about that. And then your target market. Do some good math on the target market so you don't go down a path. Make sure you know what it is. You don't have to be experts on it, but they'll run a study. If it's strategics know the market because they live it. Private equity will have to learn it.
Well, can I interrupt?
Yes.
One quick question on that previous slide.
Yeah.
You mentioned long-term contracts with the customer, so the potential buyer has some sort of they don't lose their customer base and they want some of that. Does lifetime value of the customer play into that?
It does. It depends on the business. My impression is if you are a low contract value company. So if your contract value is $500, or $1,000, honestly, even if it's $5,000, I think that matters more. But if you've got $50,000, $100,000, $200,000 contracts, often long-term value, and if you've got low churn and large contracts, the theory is they're going to be around, quote unquote, forever. So it's really hard to measure long-term value. But if you've got a high volume of lower cost deals, I think those metrics matter more. Yeah, be my thought.
Thank you.
Yeah. All right. So I think I probably already spoke about this, but 100 million ARR, you're going to see big multiples. You will have no problem raising money or selling for a lot. Above 10 million, that's a tough place to get to, but it makes you very desirable. And again, it depends on some of the other fundamentals, but typically in this current market, 10x is not unreasonable. In that 5 million, and 5 million, I'll call it anywhere from 3 to 8. Call it in that. You've got proven product market fit. You've done the first level of scaling it. These are great add-ons for PE, and those are. It depends on how you value it. I call those those can be 4 to 10x. The vast majority are probably 4 to 6. 5 to 6 is probably just to set expectations for people. You can certainly get more, but can have a whole nother talk. Structure often matters more than the number. So if you're willing to accept risk, you can get higher valuations. If you want cash, that can bring it down a little bit. And then I say 2 million in AR and below. It's very different. It's got to be a very specific product fit because the revenue won't move the needle. Large companies often just won't even look at it. Companies below a certain size. So growth, these are kind of the categories I look at. You've got declining. I had a private equity guy tell me the other day, he said, we don't want to catch a falling knife. And I thought that was kind of graphic. But some will say they like distressed properties. My message on here is we got declining, flat, sort of that 10 to 20%, which is quite common. Greater than 40%, those are more rare. Those are pretty hot. Then you've got the 100% plus, like those are the real hot shots. There are different segments of buyers for every one of these categories. So even declining is the hardest. If it's truly falling, it's going to be hard to sell for very much because they don't know where the bottom is. It really depends on why it's declining and if being acquired would stop the fall. But if the business is flat, if a lot of your metrics aren't great, there are value buyers out there. So there's a home for every category and honestly, almost every company. 10 to 20% I mentioned is pretty common. Those are good businesses. Greater than 40%. I think I talk about the rule of 40. I'm gonna be redundant. There's a rule of 40. Some of you may have heard about it. It's very real in private equity. The studies have shown that companies that have a growth rate plus an EBITDA percentage, those two combined of greater than 40%, statistically outperform those below it by a wide margin. So they'll pay a premium for those. And there's certain buyers willing to pay high multiples for those. And then 100% plus, that's, like I say, growth. The reality is if you're growing 100% plus, although I'd love to sell a company that's that category, often I'll tell people in that category, like, why would you sell it now? You'll be worth twice as much or more in a year if you truly believe you can get there. And then the range of multiples is from 1 to 20, and they're buyers that are happy. Well, they're buyers happy to pay 10 or more, and they're buyers happy to pay 1. So logo churn, I'll move quickly. I don't want this to be a lesson on logo churn, but it's a big deal. It's one of the metrics that they look at. 5 to 10% annuals is ideal. SMB, it's higher. Enterprise, it's lower. It's really just the number of clients that churn in a cohort. If you start the year with 100, how many are still standing at the end of the year? If you've got 95, you've got 95% retention. You've got 5% churn. This pro tip I've got on the bottom right, I can't emphasize that enough. Set up your statistics so that people that are doing trials, that are just kicking the tires, that those logos don't hit your actual metrics. I know when I was running a company, I wanted every logo I had on there because it felt good. But when they're looking at buying your company, they'll run an analysis on all of those, and you don't want those to skew your rate higher. Net revenue retention is one of the biggest that I see, and it's a measure of how well the clients that stay grow versus those that leave. Meaning, if those that stay buy more than the value of those that leave, it puts you over 100%. And if you're up 105, 110, 120%, that is extremely valuable. One of the biggest reasons I'll see, particularly private equity, but strategics look at it as well. If you've got a lot of churn, there's just concern about how sticky the product is. You got to remember, the reason people love SaaS is because it's sticky recurring revenue. If it's not sticky, it's not recurring. And so it hurts the valuation. This is just SaaS Capital had some metrics I thought were interesting. It kind of correlates overall growth rates for companies that over 120% tend to grow over twice as fast, almost 3 times as fast as those in the 80 to 90%. So one thing I throw out there, I do see a lot of companies that are hyper focused on sales and marketing, content creation, inbound, but they don't spend a lot of time on the client services side to focus on retention. And so that's where I encourage people, really focus on the retention early to make sure that you get it right. More data, I'll send this out. I'm not going to go through it all now. This is KeyBank did a study of 200. It just showed what, if people want to say, well, how do I compare? Here's some data that shows where you compare on the high end and the low end.
Lowell, quick question.
Yeah.
Yeah, I think you were talking about sales and marketing. Anything you'd say about CAC? That's the other metric. I know you had a little verb on LTV. What would be your couple comments on how to think about customer acquisition cost?
I would say, I'm trying to think, what is it? They want like a 5, I think, isn't 5 the magic number, like CAC to LTV? Again, I think that's going to be more, we normally do B2B. So if you've got higher volume of lower dollar customers, I think that's probably easier to measure. And I think it's more relevant. Yeah. Okay. Yeah, but they really, I think to give you better insight, I'd probably have to check the current numbers on that as well. Yeah.
Okay. Sorry. No worries. Thanks.
Okay. So total addressable market, I think we all know what that is. We talk about it, but I encourage people, do your homework, just find out, if you're selling to clinics, how many clinics are there of the size that would buy your product, and what's the value of each one of those, even as a crude number. What you don't want to do is find some number and say, hey, our market's $1 billion, and you spend a lot of time, and 2 months down the road, they do a market survey and they find out it's really only 100 million, and it falls apart. And you could have picked someone else that was in that market that already knew it, that didn't care. 100 million is small, doesn't mean they won't buy you, but it definitely makes it less attractive. $1 billion is large. Most people know that. The VC side runs through that as well. But what I found with like private equity is they'll run a study. They will hire an expert and run a study. They won't just Google some studies to see what's out there. Rule of 40, I talked about that earlier, growth percentage plus profit percentage. This is a recap, nothing new in here, kind of a summary. And like I say, growth and retention, that bottom thing is private equity, strategics, they're both good and they're often the same, and they all want growth and retention. So, okay, I ran a little bit longer than I thought. So thank you for the questions, and we've got about 10 minutes for more questions.
Hey, Lowell. So we are missing the big elephant in the room, which is the SPACs. Where do they fit into the spectrum of buyers?
Yes, well, they're pretty popular right now, and they're on fire, right? So it's and I'm not an expert on SPACs, but I've found it fascinating to watch. Actually, it's a lot of what you're seeing is private equity firms that's their exit strategy. Rather than sell to another private equity firm or go public, they're doing that through SPACs. So I'll do a little research on that. I'm not sure who's driving most of the SPACs, but I think my impression is those are still larger organizations, though. I still don't think you'll see. I could be wrong. I don't know that you'll see a lot of $5 and $10 million companies going public. But there are a lot of reasons. Again, one of the things I tell people, if you're an entrepreneur, if you've got a company, if you're doing 7 million in revenue, and you're going to sell it for 50 million by private equity, and they give you a chance to roll over 30%. If you're going to get a big chunk of 50 million, what are you going to do with it? You're going to throw it in the stock market at what, 33,000 or whatever the Dow is? Maybe that's a good idea, but why not roll 30% of it and make money alongside these guys that know how to make money better than any other category I could find? So you can take that 30%. Anyway, that's my own personal bias, but it's a good question. Yeah, SPACs are fascinating to me. It's like they found a way around the difficulties of going public.
Yeah. Hi, Loel.
Hi.
Yeah, I had a question. Can you touch upon what happens after an exit by a strategic buyer? Like how much do we get paid in cash and normal, how much do we get in stocks? How many years the payment is made into curtail tax? Like how many years the entrepreneur has to work in the buying company? And if he still has to hit the targets after being employed by the new buyer till he gets the new full amount?
Yeah, my answer would be yes. It's really, you know what, you're going to get what you negotiate. All cash at close is great. There's always a holdback in escrow. It's typically 10%. You can argue over that. If there's an earnout tied to EBITDA, those are, I think those are rarely is either side happy. I think that's a recipe for disaster because you don't control the costs. If it's an earnout tied to revenue, that's maybe not bad, but if they're going to put you in a product role and you don't have any control over revenue, they can be tricky. Earnouts are tricky and they can be frustrating for both sides. But every deal is different. It really is what you negotiate. Sometimes you'll get a higher valuation. If they say, we think your business is worth 10, and you say, I think it's worth 20, they may say, well, we'll pay you 20 if you hit these numbers, but we're going to give you 10 now, and you get another 10 if you hit those numbers. That's sometimes not unreasonable because you share the risk. I'm not sure I answered all of the pieces of your question though, but it really does depend on what you negotiate. And if you have multiple offers, someone may offer an EBITDA earnout. And you say, well, these other guys are offering a rollover, which I like piece of the new company, and someone else is all cash offer. And then you can play them against each other to get the best of all of them.
Thank you.
Yeah.
Lowell, great presentation. Couple of related questions that are in the chat, one from me and one from somebody else. Is increase in ARR from existing customers valued differently from increase in ARR from new customers? And the one asked by Wayne is, are ARR revenues from government clients rated differently than private clients?
Really good questions. That's a really good question. I'm not sure. They're both great. If you can grow overall, so if you grow through logos and the revenue stays flat, that's not bad. I think the revenue stays flat with each client, but you're growing, call it 20%, versus you don't get any new clients, but your existing clients grow by 20% per year. I mean, they're both good. You know what I'll do? I've got 3. I've had 4 calls this morning with private equity. I've got 3 this afternoon. I'll ask them. I'll find out. That's a really good question. What I do know is that they're both very valuable. I don't know if one is more valuable than the other, but I do encourage people. There are other little tricks people can do. A lot of small companies haven't had a price increase ever. Well, guess what? If you're going to sell in a year or 2 years, start doing a 5% price increase. Guess what? If you have 100% retention, all of a sudden your net revenue retention, instead of being 100%, it's going to be 105, and 105 is way better than 100. Retention is a little bit like your temperature, right? 98.6 and 104 are pretty close together, but you feel a lot worse at 104 than you do at 98.6. I think churn, net retention, same way. You had another question as well, though, and I've already lost that one. What was the tail end of that, Dan?
Government revenues.
Yeah, it depends on the buyer. I would say that if the buyer's core focus is non-government, they may not value it as much. I've got a client right now, actually, with large government contracts. And I've found different buyers. Some look at that as an avenue into the government because it's very difficult to get those contracts. Others look at it as a risk because they don't want to work with the government. So it just kind of depends on the government or on the buyer. And I apologize. I told you, Jenny, ahead of time, I'm not good with the chat while I'm talking, so I apologize. I've missed some. All right, let me go through these now. So are there tools, templates available to analyze customer churn? Yeah, maybe we should talk about that afterward. I don't know that I'm in a position to recommend the best ones. I've found there's a certain model. I don't know. I've got some model builders that I can introduce that do a good job. They're very inexpensive, but yes, and there's some automated tools that can generate this on an ongoing basis, so you can play around with it.
Lowell, I have another question.
Yep.
So we've got, in our SaaS operation, we have month-to-month sort of subscriptions, not a long-term contract, and we use that as a sell advantage, sort of like not locking your customers. But I hear you saying that buyers prefer longer term contracts for valuation purposes, right? Because of our month-to-month, we and the business that we're in, package delivery, last mile, that sort of thing, there's fluctuations, and our subscription is tied to on a monthly basis, right? So there's what we see is contraction and expansion in our MRR, right, and ultimately in our ARR as well. And so does that get taken into account? So for instance, lots of packages get delivered between November, December, January timeframe, but then there's a slump in late January, February. So people enable the subscriptions because they have more routes to sort of deliver on that kind of packages. Does that get taken into account?
Yeah, that probably requires a little bit deeper digging. Deeper digging. Yeah, that's it. That we could maybe cover another time. But okay. I would say that my general advice there that would be is if you've got if it's physician software and it's $59 per physician per month, that's pretty straightforward. If it's revenue tied to volume, it's more like transactional revenue, and it might be reoccurring, but it's different than committed subscription revenue. And then the other question, I think, like if it's monthly versus annual contracts are great, 2-3 year are even better. And then I'll just throw out there as well, just a surprise for entrepreneurs. If you have annual contracts and you force people to prepay them, that's a great way to fund your business. But be aware, when you sell your company, the buyer will look at that as deferred revenue. So if you've got $5 million in cash you brought in, that feels great, but the buyer is going to ask for that back. They're going to say that that's all future revenue that you haven't earned, that you pulled in ahead of time. It's just a big surprise for people when it comes to close and they're trying to pull it back.
Great. Hey, thanks, Lowell. Thanks very much for spending time with us, sharing all your analysis, and thanks to everyone on the call for participating. It's a great session. Thanks to everyone. Have a great weekend.
Thank you. Thanks, everyone.
Thanks. Bye-bye.
Thanks, Lowell.
Yeah, look forward to seeing people in person soon.